My name is Allan Madan from Madan CPA. As the year draws to a close, now is the perfect time to focus on year-end tax planning to minimize your personal tax bill due in April. Today, I'll walk you through 7 smart strategies tailored for individuals filing personal tax returns in Canada. Let's dive in. First up, harvesting losses or tax loss selling. This strategy lets you sell investments that have decreased in value to offset capital gains from profitable ones. For example, let's say you have an investment portfolio with these stocks. Stock A, which was purchased for $10,000 and is now worth $15,000, and stock B, which is purchased for $8,000 and is now worth $5,000. If you sell stock A to realize the $5,000 gain, you can sell stock B as well to realize the $3,000 loss. This means your net capital gain is $2,000 instead of $5,000 from selling stock A alone, which will lower your capital gains tax. If you choose to sell both stock A and stock B, be sure to comply with the superficial loss rule, which prohibits repurchasing the same investment within 30 days of the sale. Number 2, maximizing charitable donations. Another way to minimize your tax burden is to make charitable donations before the end of the year. These donations are considered tax credits that reduce your overall tax payable. These donations can be up to 75% of your net income for the year. If you don't have cash to donate, you can choose to transfer stock to charities instead. By transferring the stock instead of selling it, you avoid paying capital gains tax on the appreciation of the stock. Plus, you'll receive a tax credit equal to their fair market value. Number 3, contribute to your spouse's RRSP. This strategy allows one spouse to contribute to the other's registered retirement savings plan, RRSP account, creating a more balanced income distribution in retirement. In this case, the contributing spouse receives a tax deduction for the contribution, while the receiving spouse owns the RRSP. Having unbalanced RRSP accounts may make sense today if one spouse earns more than the other, but it can pose issues once withdrawals are taken in retirement. For example, one client we spoke to recently had $2 million in his RRSP, while his wife had $12,000. The problem in this scenario is that once the couple retires, they will have to draw more from his RRSP account, resulting in a higher tax bill for him. If that couple decides to withdraw $100,000 per year in retirement and draws down only from the husband's account, he would pay $22,401 in taxes. Alternatively, if they both withdrew $50,000 from their RRSP accounts, each spouse would only pay $7,643 in taxes, totaling $15,286 in taxes. This strategy not only benefits you today, but will also benefit you during retirement. Number 4, top up TFSA contributions. For those at least 18 years old, I recommend putting money into your tax-free savings account, TFSA. The contributions are not tax deductible, but any investment growth or withdrawals are tax-free, which will benefit you over time. The contribution limit in 2024 is $7,000, but contributions are cumulative, meaning you can contribute the maximum amount for every year since you turned 18 years old. For example, let's say Parth turned 20 in 2024, and he has never contributed to his TFSA. Given these contribution room limits, $7,000 in 2024, $6,500 in 2023, and $6,000 in 2022, Parth will be able to contribute $19,500 to his TFSA in 2024. To see what your contribution limit is, check your most recent notice of assessment or log into My Account on the CRA's website. Number 5, First Home Savings Account. The First Home Savings Account, FHSA, is a registered plan created by the Canadian government that helps first-time homebuyers save for a down payment. The contributions are tax deductible, any investment growth within the account is tax-free, and withdrawals for a first home purchase are also tax-free. This is a great opportunity for Canadians to leverage. The FHSA has an annual contribution limit of $8,000 with a lifetime contribution limit of $40,000. So the best time to get started is now. Number 6, maximize RESP contributions. For parents, you can contribute to your child's Registered Education Savings Plan, RESP, before the end of the year to receive the Canada Education Savings Grant, CESG. The CESG is a grant where the government will match 20% of your contribution to $500 annually. There is no annual contribution limit on the RESP, and the contributions are non-deductible. However, the grant is only offered for the calendar year and is a use it or lose it opportunity. Number 7, capture income in the current year. Lastly, strategic year-end tax planning can help you capture income in the current year to reduce your overall tax burden in the following year. This is useful if you anticipate a raise or if you're a sole proprietor that expects to serve more clients in the coming year. This is important because your marginal tax rate in the following year will increase, meaning your overall capital gains tax rate will increase. To capture income, you could sell investments with unrealized gains or exercise stock options that are in the money. I just outlined 7 different ways individuals can minimize their tax burden through year-end tax planning. Though they may not all apply to you, there are certainly a few you should be able to take advantage of. If you'd like to learn some tips for businesses, write a comment below. Take the time to review your financial situation and consult with a tax professional to ensure you're making the most of these opportunities. See you in the next video.